Okay, let's unpack this. We're diving deep today into a question that's probably crossed the mind of almost anyone who's ever thought about building wealth, the U.S. real estate versus the stock market. There's something fundamentally human, almost primal, about owning a piece of the world, isn't there?
Yeah, definitely.
That tangible sense of land, a home, a building you can touch and see, maybe even walk around in. It feels solid, permanent, reliable. Contrast that with owning shares in a company, an abstract number on a screen representing ownership in something vast and often intangible, subject to the whims of daily trading.
That contrast is absolutely key. For many people, direct property ownership feels intuitively safer, more real. It taps into something deeply ingrained, particularly here in the U.S.
Right.
It's interesting. The research we looked at mentions that surveys consistently show a significant percentage of Americans view real estate as the most reliable path to building a nest egg. It's tightly woven into the fabric of the American dream narrative.
Absolutely.
Yeah.
And that widespread perception is exactly what we're here to challenge and explore. We've been given a collection of sources, articles, research papers, market data that really dig into this age-old debate, comparing these two major investment avenues.
Yeah, and they're not just repeating conventional wisdom. They're peeling back the layers of perception to look at the cold, hard data and the practical realities.
Exactly. Our mission today is to move beyond that common perception and that emotional connection to tangibility. We want to understand what the experts and the historical numbers in these sources actually tell us about the historical performance, the fundamental differences in how these assets behave, the often overlooked costs and challenges, and of course the opportunities in both direct U.S. property investing and investing in the real estate sector through the stock market.
Using something like an ETF like XLRE as our representative example for listed real estate.
Yeah.
Yeah.
We're here to give you the most important nuggets from this stack of information.
So forget the gut feeling for a moment, or at least put it in context. And let's look at what the facts and figures from this research show us about which path has actually delivered over time and under what conditions.
Okay, let's set the stage with the big picture on historical performance.
Setting the stage with historical performance is crucial because it provides the essential long-term context. When you look at the big picture data spanning multiple decades, say, from 1992 right up through early 2024.
Okay.
The stock market, specifically as represented by the S&P 500 index with dividends reinvested, has delivered significantly higher average annual returns compared to the broad U.S. housing market.
And when we say significantly higher, we're not talking about a small difference, right?
Yeah.
The S&P 500 during that period saw an average annual return of about 10.39% before accounting for inflation.
Yeah, that's nominal.
After adjusting for inflation, the average annual real return was still a very robust 7.66%.
Correct. And during that same comprehensive period, the U.S. housing market, tracked by indices like the Case-Shiller, grew at a considerably lower rate, roughly 5.5% annually on average.
Oh, wow. Okay.
So over these long, multi-decade timeframes, the stock market, particularly broad market indices like the S&P 500, has demonstrably outperformed direct housing in terms of pure average percentage return. The sources are quite consistent on this long-term finding.
But you mentioned pure percentage return, and the sources also emphasize that it's not just a simple monolithic win for stocks across the board or in all circumstances.
Yeah.
There's nuance.
Absolutely, and the nuance is vital. While stocks hold the edge over the very long run, the sources point out there have been specific periods within those decades, sometimes lasting several years, when housing performed better, offering stronger returns.
Okay, like local market booms or something.
Exactly. Think about local market dynamics or specific boom periods not perfectly aligned with the broader stock market cycles. And as one piece of research emphasizes, pure nominal return isn't the only factor investors care about or should care about. Right. We have to factor in things like the potential for rental income, different tax advantages, the impact and accessibility of leverage, and the cost of ownership, all of which vary significantly between these two asset classes. Those differences can drastically alter the net outcome for an individual investor.
That makes total sense. Just comparing price appreciation numbers is too simplistic. So let's dig into those factors. Moving beyond just the historical return figures, what are the fundamental structural characteristics that truly set direct real estate and stocks apart as investments?
Well, the most obvious difference, and perhaps the one that resonates most deeply with people, is the concept of tangibility and utility. Real estate is a physical asset.
Right.
It's land, a house, a store, an office building. You can drive by it, you can walk through it, you can potentially live in it or use it for a business. It has a practical, real-world use case beyond just being an investment vehicle.
You feel connected to it somehow.
Yeah, you feel connected to it, you care for a home, you maintain a property, you interact with tenants.
And stocks couldn't be more different on that front.
Not at all. Stocks are inherently abstract. They represent a small share of ownership in a company. While that company does own physical assets, maybe buildings, factories, computers, the stock certificate itself, or, the digital entry in your brokerage account, is simply a store of value and a claim on future earnings.
Just numbers on a screen, essentially.
Pretty much. The value of your stock goes up or down based on market perception, company performance, and macroeconomic factors, not because you painted the walls or fixed a leaky faucet. The sources explicitly contrast this feeling of caring for your tangible home versus the very abstract nature of market gains and losses.
That really highlights why people feel so differently about them. One feels solid, the other. Well, like numbers on a screen, you can't control in the same direct way.
Exactly.
What about volatility? The sources make a significant point about how differently volatile each can be.
Traditionally, yes, stocks are considered far more volatile than real estate, meaning their value tends to swing up and down more dramatically and more frequently. While real estate can experience sharp downturns, the 2007-2008 financial crisis demonstrated that painfully the pace and magnitude of typical movements are different. Stocks are generally more prone to large, fast swings in value, driven by news cycles, investor sentiment, and instantaneous trading.
Right, like daily or even hourly changes.
Precisely. The sources give a very compelling illustration of this difference. During the initial shock of the pandemic, from the first to the second quarter of 2020, the median home price in the U.S. fell modestly, by around 3.4%.
Okay, just 3.4%.
In stark contrast, the S&P 500 experienced a much sharper, faster drop of about 33% between January 1st and late March of that year before beginning a rapid recovery.
Wow, 33% versus just 3.4% in essentially the same short time frame. That's a dramatic difference in how your wealth held in that asset would have reacted to a sudden shock.
It really highlights the difference in how quickly and violently values can change in the stock market compared to the housing market. The research includes charts that visualize this, showing how the S&P Case-Shiller U.S. National Home Price Index, which tracks residential real estate prices, tends to rise more steadily and with less dramatic fluctuations over the past decade compared to the S&P 500.
So smoother line for housing on the graph.
Generally, yes. The S&P 500 shows greater growth, but also significant volatility tied to major economic events. And when you look at even more concentrated or growth-oriented indices like the NASDAQ, heavily weighted towards technology stocks, the volatility is even higher, with sharper peaks and deeper corrections.
There's a bumpier ride.
Exactly. This visual evidence reinforces that while real estate isn't immune to downturns, its valuation typically doesn't experience the same rapid, deep value swings as publicly traded stocks, especially those in more dynamic sectors.
And the appraisal process probably smooths things out too.
Absolutely. The appraisal process for direct real estate also inherently lags market sentiment compared to real-time stock trading.
Okay, so tangibility, real-world utility, and generally lower day-to-day volatility tend to favor direct real estate, comparatively speaking. What about the actual costs involved in owning these assets? Because owning property definitely feels like it comes with a lot more bills than owning shares in a fund.
It absolutely does, and this is where the practical differences really pile up. The sources detail the substantial difference in costs of ownership and management between direct real estate and stocks. Direct real estate owners face significant, ongoing, and often unavoidable expenses.
Like what specifically?
These include property taxes, which are typically levied annually and can range from 1% to 2% of the property's assessed value, sometimes even higher depending on the location.
1% to 2% every year just in taxes.
Right. Then there are maintenance costs, which are a perennial expense. Experts often budget around 1% of the property value annually for regular upkeep and unexpected repairs. Leaky roofs, broken appliances.
Always something.
Always something. Insurance is another necessity. And if you're not living in the property yourself, if it's a rental investment, you might incur property management fees, which commonly range from 8% to 12% of the rental income.
Ouch, 8 to 12% just to have someone else handle it.
Yeah. These are all substantial, recurring costs that eat into your gross return and require active attention and budgeting.
And for stocks, how does that compare?
For stock investors, particularly those investing in broadly diversified index funds like the S&P 500 or sector-specific ETFs, the annual fees are dramatically lower, often negligible by comparison.
Like how low?
The research states that many high-quality stock index funds charge expense ratios of just 0.03% to 0.15% annually.
0.03%. That's tiny compared to property taxes alone.
It's literally orders of magnitude less than the ongoing costs of owning and maintaining physical property. Furthermore, managing a stock portfolio generally requires far less time and effort once the investments are made compared to actively managing a physical property, especially a rental or commercial one, which some sources accurately liken to running a full-time job, depending on the scale.
That time commitment is a hidden cost for sure. What about leverage? That's a massive part of how people typically acquire real estate, right? It feels much easier to get a big loan for a house than for stocks.
Leverage is a major differentiator, and it's far more accessible and commonly used for direct real estate investing for the average person. You can often purchase a property, whether it's a home or an investment property, with a down payment of 20%, 10%, or even less.
Right, FHA loans and things.
Exactly. Using a mortgage to finance the remaining 80% to 90% of the purchase price, this allows you to control an asset worth significantly more than your initial cash outlay.
So you amplify your potential gains.
Yes, but the sources correctly highlight how leverage acts as a double-edged sword. It magnifies both potential gains and potential losses.
Right, the downside too.
Absolutely. If the property value increases by, say, 10%, your return on your initial 20% down payment is magnified 5 times before considering debt costs. But conversely, if the value falls, you can lose more than your initial investment, potentially even ending up owing more on the mortgage than the property is worth, especially in a sharp downturn.
Underwater, as they say.
Precisely.
And for stocks, you don't typically get that kind of leverage opportunity as a regular investor.
While leverage is possible in the stock market, often through margin accounts offered by brokerages, it's far less common, accessible, and generally recommended for the average long-term investor compared to real estate.
Why is that?
Margin loans come with interest costs and the risk of margin calls, where the brokerage can force you to sell shares if the value drops, potentially locking in losses at the worst time. Day traders or highly sophisticated investors might use it, but it's not the standard path for building wealth through conventional stock ownership in the same way a mortgage is for buying a property. So direct real estate offers a more readily available and culturally accepted path to using significant leverage.
So real estate generally wins on leverage accessibility for the typical investor, amplifying potential returns but also risk. Now, let's talk about something critical that the sources spend a fair bit of time on, and that's liquidity. This is where the differences get really stark.
Liquidity. This is perhaps the single biggest practical difference for your financial life, especially in times of need. Liquidity refers to how quickly and easily an asset can be converted into cash without losing significant value.
Right.
The sources are crystal clear and unequivocal. Real estate is inherently structurally illiquid compared to publicly traded stocks.
Illiquid, meaning hard to turn into cash quickly without taking a hit. Why is it so illiquid? What makes it slow?
There are several interconnected reasons detailed in the research. First, the sheer transaction time. Selling a property is not an instantaneous event. It takes time, often months, potentially even longer in a slow market or for less common property types.
Tons.
Oh yeah. You have to prepare the property, list it, market it to potential buyers, wait for offers, negotiate terms and price, go through the due diligence process, inspections, appraisals, and then wait for the buyer to secure financing, which can be a lengthy process with potential hurdles.
Wow, that's a lot of steps.
This entire sequence takes considerable time. Stocks, on the other hand, are traded on major exchanges like the NYSE or NASDAQ. You can typically sell shares instantly during market hours with just a few clicks on a brokerage app, and the cash is available within a couple of business days.
So speed is one major factor. What are the others that make it illiquid? Complexity and cost.
Complexity and costs are huge contributors. Selling real estate involves a complex process with extensive paperwork, legal contracts, appraisals, title searches, and various closing steps. And the transaction costs are substantial.
How substantial are we talking?
For direct commercial property, for example, the sources explicitly mention that broker fees alone can be as high as 6% of the sales price.
6%, just for the broker.
Yep. When you add in legal fees, title insurance, escrow fees, potential transfer taxes, and other closing costs, you're looking at a significant percentage of the property's value being eaten up just in the process of selling it.
And stock trading costs.
Stock trading costs, while they exist, brokerage commissions, regulatory fees, are generally a tiny fraction of the transaction value by comparison, especially with the prevalence of zero commission trading these days.
That makes the difference in liquidity, not just about speed, but also about how much of your value you lose just trying to get your cash out. What are the real-world consequences of that illiquidity for a direct real estate investor?
The illiquidity means you lack flexibility when you might need it most. If you suddenly face a financial emergency, a job loss, a medical crisis, a need to fund another opportunity quickly, you cannot instantly tap into your real estate equity without a potentially painful and slow process.
Right, you're stuck.
You might be forced into a situation where you have to sell quickly, and to do that, you may need to drastically lower the price, selling at a significant discount below the property's true market value, simply because you need the cash now and the pool of ready, willing, and able buyers for a quick close is small.
Oof, forced selling at a loss.
It happens. With stocks, you can typically sell shares at or very close to the current market price and have the cash available promptly. The sources really emphasize this point. You often don't fully appreciate the impact and risk of illiquidity until you are in a situation where you desperately need access to your capital quickly.
That's an absolutely critical point. It's a challenge that feels abstract until you face it. Finally, on core differences, let's touch on taxes, because the sources highlight distinct advantages for each type of investment.
Taxes are indeed treated differently, and these differences can significantly impact the net return you actually get to keep. For direct real estate, there are some notable potential tax advantages in the U.S. system. If you sell your primary residence, you can exclude a significant amount of capital gains from taxation up to $250,000 for single filers and $500,000 for married couples filing jointly.
Wow, $500,000 tax-free.
Potentially, yes, provided you meet certain ownership and use tests, you've owned and lived in it for at least 2 of the 5 years before the sale. This is a major potential benefit not available for stock sales.
Okay. What about investment properties?
For investment properties, owners can often deduct mortgage interest payments and property taxes, reducing their annual taxable income.
And depreciation too, right?
Yes, depreciation write-offs are another potential benefit, letting you deduct a portion of the building's cost over time.
And there's also the famous 1031 exchange for investment properties, right? Can you explain that?
Yes, the 1031 exchange, also known as a like-kind exchange, is a powerful tool specifically for real estate investors who own investment or business properties. It allows you to defer paying capital gains taxes and depreciation recapture taxes indefinitely by swapping one investment property for another of kind of equal or greater value.
Indefinite, so you never pay the tax unless you finally cash out.
Essentially, yes, as long as you keep rolling it into new properties. However, the sources note it has strict IRS rules and timelines. You must identify a replacement property within 45 days of selling the original property and complete the purchase of the new property within 180 days.
Okay, 45 days and 180 days. Got it.
It's a potent strategy for compounding wealth without triggering taxes, but it requires careful planning, adherence to rules, and the intention to continue investing in real estate.
What about stocks from a tax perspective? Any advantages there?
Stock investors benefit from potentially lower long-term capital gains rates. For assets held for over a year, any gain is typically taxed at preferential rates, currently 0%, 15%, or 20% depending on your income bracket, which are often lower than ordinary income tax rates.
So lower tax rate if you hold long-term.
Correct. Assets held for a year or less are taxed at your higher ordinary income rate. Qualified dividends from certain stocks also receive this preferential long-term capital gains tax treatment.
Okay.
So while real estate offers deductions, exclusions on a primary home, and potential tax deferral through 1031 exchanges, stocks offer potentially lower overall tax rates on gains and income if held for the long term.
Okay, that really covers the landscape of core differences: tangibility, volatility, costs, leverage, liquidity, and taxes. It's clear they are fundamentally different creatures as investments. Now, let's really zero in on some of the significant challenges of direct property investing, especially when you're looking beyond just personal residence like commercial properties.
Yeah, things get even more complex there.
The analysis we reviewed from commercial real estate firm FNRP in particular lists quite a few potential downsides for direct ownership that are worth detailing.
That FNRP analysis lays out the disadvantages of direct commercial real estate investing quite starkly, and it resonates with what you hear from people who have done it. The first and often biggest hurdle it mentions, and one we touched on with costs, is the sheer high capital requirement.
Right. It's not like buying a few shares of a stock index fund for $100. You need serious money up front.
Precisely. Commercial properties, office buildings, retail centers, industrial warehouses, even smaller ones suitable for individual investors, though they are still large, are expensive assets measured in the millions, tens of millions, or even hundreds of millions of dollars.
Millions. Wow.
The FNRP source gives a concrete example, buying a $20–30 million grocery store anchored retail center. Even assuming you can secure a favorable loan that covers, say, 60–75% of the value, an investor might still need to come up with $5 million to $8 million in equity for the down payment alone.
$5 to $8 million
Yeah.
just for the down payment.
Just for the down payment. And that's assuming the property is in perfect condition and fully leased. If renovations or tenant build-outs are needed, that upfront capital requirement jumps even higher.
Yeah.
This level of required equity simply makes direct commercial property ownership infeasible for the vast majority of individual investors. It's a massive barrier to entry.
That scale of capital needed puts it out of reach for most. What about the time and expertise needed to manage one of these properties? That also sounds like a significant challenge.
The sources are absolutely clear that managing a commercial property isn't just a passive investment. It's essentially running a complex small business or operations center.
Like a second job, almost.
Or a first job. It requires a significant time commitment and specific, often learned expertise. The FNRP source lists a whole range of tasks that can make it feel like a full-time job. Everything from coordinating routine services like trash removal and landscaping to performing regular maintenance on HVAC systems, electrical, and plumbing.
All the practical stuff.
Right. You have to collect rent from potentially multiple tenants, handle lease enforcement, pay property taxes, negotiate new leases, manage tenant issues, noise complaints, repair requests, and oversee any renovation projects.
That sounds exhausting just listing it.
It requires being hands-on or having expert knowledge to supervise professional managers. Not everyone has the time, temperament, or the specific experience to do all this effectively.
And if you don't do it well, it directly impacts your investment return, as the sources mentioned. What about the financing challenges? We discussed leverage, but getting the actual commercial loan seems like a different beast than getting a residential mortgage.
Yes, securing financing for commercial property adds another significant layer of complexity compared to a standard home mortgage. Commercial lenders scrutinize the deal much more intensely.
How so?
They look not just at the property's potential cash flow and its valuation, but also the borrower's personal financial strength and experience. Lenders often require personal guarantees from the borrower.
Personal guarantees, meaning you're personally on the hook if the property fails.
Exactly. Meaning that if the property's income isn't enough to cover the debt service and the property goes into default, the investor is personally liable for the loan, exposing their other personal assets to risk.
That's a huge risk.
It increases the stakes significantly. The sources also note that financing terms can be harder to get or more expensive for riskier property types like distressed retail or unproven concepts compared to more stable, established assets. Establishing relationships with commercial lenders and demonstrating personal financial acumen are crucial steps, and not easy for newcomers.
So even if you have the down payment capital, getting the debt isn't guaranteed and comes with personal risk. We talked about illiquidity already, but the sources emphasize it specifically as a major challenge for direct commercial property.
Reiteration here is essential because illiquidity for commercial property can be even more pronounced than for residential. For larger, multi-million-dollar commercial assets, the pool of potential buyers is dramatically smaller than for, say, a family home.
Fewer people have that kind of money or interest.
Precisely. This further limits how quickly you can find a buyer. Selling a property that requires multi-million-dollar financing and appeals to a niche group of investors can take a very long time, sometimes well over a year in slower markets.
A year or more just to sell.
It's possible. And as we mentioned, the transaction costs, like broker fees, up to 6% is a substantial cut of a multi-million-dollar sale. Legal fees and closing costs remain very high. This means your capital is tied up for potentially a very long time, making it exceedingly difficult or expensive to access quickly if personal or market circumstances change.
And property management for commercial properties.
Yeah.
You said the FNRP source called it a pain point. Why is it such a headache?
The FNRP analysis indeed calls it a significant pain point. It involves the constant granular operational management of the property. This covers everything from marketing vacancies and screening tenants to negotiating and managing complex commercial leases, collecting rent diligently, handling tenant requests and complaints, coordinating maintenance and repairs, and managing vendors for services like security or cleaning.
It's nonstop operations.
Pretty much. Doing this well requires professional skill, experience, and often knowledge of local market dynamics, legal requirements, and tenant relations. Poor management directly impacts the property's cash flow through vacancies, tenant disputes, or deferred maintenance, ultimately hurting the investment's performance.
So you really need to know what you're doing or hire someone who does.
Exactly. Many direct owners find the time and expertise required for effective commercial property management to be overwhelming, leading them to rely on third-party managers, which adds another significant cost layer, 8–12% of rent, as noted earlier.
And that management challenge directly ties into the risk of variable income.
Absolutely. The income from a commercial rental property is not guaranteed or fixed. It's subject to fluctuations based on tenant occupancy and rental rates.
Right, tenants leave.
The sources give a vivid scenario. Imagine owning a small office building with 3 main tenants. If one major tenant decides not to renew their lease or goes out of business, overnight, 1/3 or more of your rental income vanishes.
Poof, gone.
This isn't like losing a single stock dividend payment. This sudden loss of revenue can easily push the property's income below its operating expenses, mortgage, taxes, insurance, maintenance, forcing the owner to inject more capital out of pocket just to cover costs while they scramble to find a new tenant.
So you have to feed the property money.
Potentially, yes. That vacancy period could last for months, sometimes even a year or two, depending on market conditions and the property type, putting a significant strain on the owner's personal finances. This variable income risk, especially for properties with a limited number of large tenants, is a major challenge that requires deep pockets and patience.
That scenario makes the income volatility risk very real. And finally, there's a technical concept mentioned in the sources. Negative leverage. What is that, and why is it a challenge?
Negative leverage occurs when the interest rate you are paying on the debt used to finance the property is higher than the property's capitalization rate, or cap rate.
Okay, what's the cap rate again?
The cap rate is essentially the unlevered rate of return the property generates based on its net operating income relative to its purchase price. In simple terms, the cost of borrowing the money is higher than the return the asset itself is providing purely from its income.
So the loan costs more than the property earns on its own.
Exactly. This creates a drag on your overall return on equity. It means that using debt financing actually reduces the investor's percentage return on the cash they put in compared to if they had bought the property with all cash.
That seems counterintuitive to why you'd use leverage.
It is. In a negative leverage scenario, you often have to put in more of your own capital, increase the down payment to make the deal work, or accept a lower overall leveraged return. And sometimes, if the negative leverage is severe, the deal might only make financial sense if bought with all cash, removing the benefit of leverage altogether. It's a challenging situation that requires careful financial modeling to avoid.
So, direct property ownership, particularly for commercial assets, while offering tangibility and the potential for magnified returns through leverage, comes with some significant high-stakes challenges. Immense capital requirements, demanding time and expertise, complex financing with personal risk, severe illiquidity, variable income risk that can require cash calls, and the potential drag of negative leverage.
Ew, yeah.
It's clearly a far more involved, capital-intensive, and risk-layered investment than many people initially assume based on the simple idea of owning property.
Correct. And these challenges, particularly the capital barrier and management burden for commercial properties, are precisely why the sources discuss alternative, more accessible ways for individuals to gain exposure to real estate.
Which brings us to the hybrid model.
Yeah.
Real estate investment trusts, or REITs, and focusing specifically on investing in the real estate sector through the stock market, like via an exchange-traded fund, such as XLRE.
Mm-hmm.
This seems to be presented as a way to potentially get some of the benefits of real estate exposure with the structure and accessibility of stock market investing.
Exactly. Think of REITs as companies that specialize in owning, operating, or financing income-producing real estate. They function much like other corporations, but their business is real estate.
What kind of real estate?
They invest in a wide range of property types. Think offices, apartments, shopping centers, industrial warehouses, medical facilities, hotels, even specialized properties like data centers or cell towers.
Okay, pretty diverse.
Yeah. The key legal characteristic that defines them as REITs in the U.S. is that they are required to distribute at least 90% of their taxable income to their shareholders annually, primarily as dividends.
So they are like real estate companies, but they have to pay out most of their profits. And you invest in them just like regular stocks.
Precisely. Their structure allows them to be publicly traded on major stock exchanges, just like shares of Apple or Amazon. You can buy shares in individual REIT companies focusing on specific sectors, like apartment REITs or data center REITs. Or, as the sources discuss and we're highlighting today, you can invest in an ETF that tracks a broad index of real estate companies. XLRE, the Real Estate Select Sector SPDR Fund, is a specific example cited in the material.
Okay, XLRE.
It's an ETF designed to track the performance of the real estate sector within the S&P 500 index, excluding mortgage REITs. This gives you exposure to a portfolio of large, established real estate companies like Prologis, Industrial Logistics, American Tower, Cell Towers, Welltower Healthcare, and Equinix data centers, among others listed in the source data.
All through one investment.
Exactly, through a single, easily tradable investment.
Okay, so that's the mechanism. What are the key advantages of investing through REITs or an ETF like XLRE compared to buying a property directly? You mentioned they offer some of the benefits of real estate with stock-like characteristics.
The first major advantage, which directly addresses the biggest drawback of direct property we just discussed, is liquidity. This is a massive selling point.
Back to liquidity.
Right. REIT shares are traded on public exchanges, meaning you can buy or sell them quickly during market hours, just like any other stock. There's no months-long process, no complex negotiations with individual buyers, and the transaction costs, brokerage commissions, are typically minimal compared to real estate broker fees.
So you can get your money out fast.
Relatively quickly, yes. You can access your capital relatively quickly if you need it.
That's a huge difference for flexibility. What else? Diversification.
Diversification is another critical benefit that's much more accessible through REITs. A single REIT often owns a portfolio of dozens or even hundreds of properties across different geographic locations and property types.
Okay, so not all your eggs in one property basket.
Exactly. And a REIT ETF like XLRE offers even broader diversification. Looking at XLRE's sector allocation profile from the sources, it has significant portions allocated to specialized REITs, a diverse category including data centers, self-storage, infrastructure like cell towers, healthcare properties, residential apartments, retail shopping centers, and industrial warehouses logistics.
Wow, that covers a lot of ground.
Investing in XLRE gives you exposure to potentially thousands of properties and various subsectors of the real estate market with one investment, a level of diversification that's simply impossible for most individual investors buying one or two properties directly due to the capital constraints.
Right.
This diversification helps mitigate the risk associated with any single property or specific local market.
So instant liquidity and broad diversification are big wins.
What about accessibility? Easier to get into.
Accessibility is dramatically higher than direct ownership. You can invest in REITs or a REIT ETF like XLR with significantly less capital than is required to make a down payment on a property.
How much less?
You can often start with just a few hundred or a few $1,000s through a standard taxable brokerage account.
Okay, so anyone can basically participate. Pretty much. You can also typically hold REITs or REIT ETFs within retirement accounts like IRAs or 401ks, though availability depends on your specific employer plan, allowing you to get real estate exposure within a tax-advantaged wrapper. This opens up real estate as an investment class to a much broader range of investors who don't have millions sitting around for a direct purchase.
And they're known for providing income, aren't they? That 90% distribution rule must mean something.
Yes, REITs are known for providing passive income through dividends. Because they are required to distribute at least 90% of their taxable income, they often have higher dividend yields compared to many other types of stocks.
Higher yields? Like how much?
The sources note that the average REIT dividend yield in early 2024 was around 4.1%, which was significantly higher than the S&P 500's average yield of about 1.3% at the time.
4% versus 1.3%. That's a big difference for income seekers.
It can be very attractive, yes, although it's important to note that dividends can fluctuate based on the REIT's performance and market conditions.
Right, not guaranteed. Interesting. And what about the idea of real estate being an inflation hedge? We mentioned that's a perceived benefit of direct property. Does that apply to REITs as well?
Yes, the sources discuss how many REITs can offer a natural hedge against inflation. This often comes through the structure of their rental contracts, which frequently include provisions for annual rent increases, either based on a fixed percentage or tied to inflation indices.
So rents go up with inflation.
Potentially, yes. Crucially, the research introduces the concept of pricing power within certain property types that REITs own.
Pricing power, what's that?
Assets like data centers, self-storage facilities, and logistics warehouses, property types that feature prominently in the listed real estate universe, as shown in some of the data visualizations, often have strong pricing power.
Meaning they can raise rents easily.
Essentially, yes. Their tenants are less sensitive to small rent increases, either because the cost is a smaller portion of their overall business expense, like a small self-storage unit for a small business, or because the location or service is mission critical, like data centers or logistics hubs.
Okay.
This allows REITs in these sectors to sustainably pass rising operating costs, like utilities or labor, onto their tenants through rental increases, driving revenue growth, and supporting property valuations even during periods of inflation.
So they can protect their profits from inflation.
They have a better ability to do so than, say, properties where tenants are very price sensitive and might just leave if rents go up too much.
So REITs can potentially offer that inflation protection through built-in rent escalators and the pricing power inherent in certain types of properties they own, properties that are difficult for individuals to invest in directly. How have REITs performed compared to other asset classes over time? Is it similar to direct property?
The sources revisit the performance comparisons, this time including listed property, REITs. Historically, over very long periods, I think 20 to 50 years, REITs delivered similar or slightly higher long-term average returns compared to direct property.
Okay, similar long-term.
However, their short and medium-term dynamics are quite different from direct property and different from broader stocks. Because REIT shares are traded daily, their valuations react immediately to market changes, particularly changes in interest rates and investor sentiment.
So they move more like stocks day to day.
Yes, much more so than direct property. Direct property valuations, based on periodic appraisals and actual transaction comps, tend to lag behind the market. This lag effect, especially evident when central banks rapidly increased interest rates, can create price dislocations where a listed property, REITs, might become temporarily undervalued or overvalued relative to direct property values.
Interesting disconnect there.
Yeah. The analysis notes that while REITs generally had an edge over very long periods, broader stocks, S&P 500, had the edge in the most recent decade leading up to the March 2024 data.
Okay, what about XLRE specifically?
Looking specifically at XLRE, since its inception in October 2015, it has delivered an average annual return of around 7% as of early 2025, which you'd compare to other benchmarks over that specific 9-year period.
7% annual average for XLRE since late 2015. Okay, so REITs seem to offer a compelling package. Liquidity, diversification across many properties and sectors, accessibility with lower capital, consistent income potential, and that inflation hedge through rent increases and pricing power in key sectors. That sounds pretty good, especially compared to the direct ownership challenges.
These offer a lot of advantages.
But they're not without their own risks and drawbacks, right? Nothing's perfect.
Correct. It's not a perfect solution, and the sources detail these as well. One of the main sensitivities for REITs is interest rate risk.
Interest rates again. How do they affect REITs?
Rising interest rates can impact REITs in several ways. They can make the relatively stable income streams from REIT dividends less attractive compared to the rising yields on bonds, which can pressure REIT stock prices. Higher rates also increase the borrowing costs for REIT companies, impacting their profitability and potentially slowing down development or acquisitions.
So rising rates can hurt their stock price and their business.
Potentially, yes. Also, while REITs generally provide higher yields than typical stocks, their dividends are often classified and taxed as ordinary income for U.S. investors, which can be at higher rates than the preferential rates applied to qualified stock dividends or long-term capital gains from selling stock.
So maybe a higher tax bill on the dividends compared to stock dividends.
It's possible, depending on your tax bracket and the nature of the dividend.
And you give up some things you get with direct ownership, like the leverage and tax breaks we talked about.
Yes, that's the key trade-off noted in the research. With REITs, you lose the ability to use significant personal leverage through mortgages at the individual level to control a large asset with a small down payment, though the REIT company itself uses leverage at the corporate level.
Right. The company uses debt, but you don't get that personal leverage multiplier.
Correct. You also lose some of the specific tax advantages available only to direct property owners, such as the large capital gains exclusion on the sale of a primary residence, or the ability to execute a 1031 exchange to defer taxes indefinitely when swapping investment properties.
Okay, so no 1031 for REITs.
No. And you completely lose the direct control you have over a physical property.
Yeah.
You can't decide to renovate a specific building to boost its value or respond directly to a very specific local market opportunity.
We're just along for the ride with the REIT management.
Pretty much. For XLRE specifically, as an ETF, risks include its sector concentration. It's 100% real estate, so not diversified across the whole economy. Potential tracking error. It might not perfectly replicate its underlying index performance. And the possibility, though usually small, of trading at a slight premium or discount to its net asset value.
Okay, that gives us a really comprehensive picture of direct ownership versus the redditive for like XLRE, covering the fundamental differences, the significant challenges of going direct, and the hybrid nature and specific advantages, drawbacks of REITs. Now, let's ground this discussion in the current market context because the report we reviewed from investment bank J.P. Morgan provides a specific outlook for the U.S. housing market as we head into 2025.
Yeah, bringing it to the present day is important. The J.P. Morgan analysis characterizes the current U.S. housing market environment as of late 2024 and early 2025 as largely frozen.
Frozen, what does that mean? Low activity?
Basically, yes. Subdued price growth is expected in 2025, with projections generally around 3% or even less nationally. Very slow transaction volume.
Why are they calling it frozen? What's causing that? High mortgage rates.
The primary driver, according to the report, is the persistence of high interest rates, what they describe as a higher-for-longer scenario for borrowing costs. Mortgage rates remain elevated. The report forecasts they will ease only slightly to around 6.7% by the end of 2025.
Still close to 7%. Ouch.
These high borrowing costs dramatically reduce affordability for potential buyers and significantly suppress demand for purchasing homes, freezing transaction volumes compared to the low-rate environment we saw just a few years ago.
And what about supply? There's always talk about a housing shortage in the U.S. Is that still the case?
Supply remains tight nationally, but the J.P. Morgan report points out that while long-term underbuilding over the past decade is a contributing factor, the most immediate and significant constraint on available homes for sale is what they term the lock-in effect.
The lock-in effect. Explain that.
The vast majority of existing homeowners refinanced or purchased their homes when mortgage rates were dramatically lower, often in the 3–4% range.
Right, during the pandemic boom.
Exactly. This creates a powerful financial disincentive to sell their current home. Why would you give up a 3.5% mortgage to finance a new home at 7%? It just doesn't make financial sense for most people.
So people who have cheap mortgages are staying put, which drastically limits the supply of homes coming onto the market.
Exactly. It's a significant bottleneck in the current market. This keeps existing home inventory near record lows despite the high prices.
Makes sense. What about new construction?
The report does mention that new home construction is normalizing somewhat, which should add some supply over time, but other complex factors are at play, like the supply of immigrant labor in the construction industry, which the report notes is critical.
So labor supply affects new building.
Yes.
Yeah.
And despite the overall affordability challenges created by high prices and high rates, the wealth effect from existing home equity gains and the recovery in equity markets is helping some buyers overcome the cost hurdles.
Ah, so people with equity can still buy.
Some can, yes. Which the report suggests is why price growth remains positive, albeit subdued, rather than turning negative nationally.
The J.P. Morgan analysis also briefly touches on how potential policy changes could impact the market, particularly under a potential future administration. What does it say there? Anything interesting?
The report notes potential policy discussions that could come into focus, such as efforts to streamline zoning approval processes, which could theoretically increase the speed and ease of new construction, or potentially making federal land available for development.
Could those help with supply?
Theoretically. However, it also highlights the complexity and potential unintended consequences. For instance, the idea sometimes floated that reducing immigration would lower housing demand and costs is countered by the report's observation that immigrants make up a significant portion of the construction labor force, around 30%.
Oh, so less immigration could actually mean less building.
Paradoxically, yes, it could exacerbate the housing supply problem by reducing the labor needed to build more homes.
Yeah, interesting point. Anything else on policy?
The report also mentions that any hasty moves towards privatization of government-sponsored enterprises like Fannie Mae and Freddie Mac, which play a huge role in the U.S. mortgage market,
Wait, they back most mortgages.
could potentially lead to even higher mortgage rates for borrowers if it removed the implicit government backing that currently helps keep funding costs lower. These are presented as complex potential future factors that could influence the market landscape.
So the current U.S. housing picture, according to this analysis, is one of high rates, suppressed demand, critically low supply driven by the mortgage lock-in effect, and slow price growth expected, with potential future policy debates adding layers of complexity.
Yeah, it's a tricky environment.
It paints a picture of a market that's fundamentally different from the frenzy of a few years ago.
That summarizes the current environment and near-term outlook as described in the J.P. Morgan analysis quite well. A very different market indeed.
Okay, we've covered an immense amount of ground today in this deep dive. We've looked at the long-term historical performance data, compared the fundamental characteristics of direct real estate versus stock market investments, tangibility, volatility, costs, leverage, liquidity, taxes.
Yep, the whole list.
Explored the significant hurdles and complexities of direct property ownership, especially commercial, introduced real estate investment trusts, REITs, and real estate sector ETFs like XLRE as a hybrid alternative, offering liquidity, diversification, and accessibility, along with their own risks, and grounded all of this in the current U.S. housing market context of high rates and low transaction volume.
It's been a thorough comparison.
Now, let's synthesize all of this. What's the big so what? So what does all this information mean for you as an individual investor trying to decide where to put your hard-earned money in the U.S. market?
Well, the sources bring it back to the individual investor by clearly reiterating the core trade-offs we've discussed, framing them not just as academic points, but as practical considerations for your financial life.
Right.
Direct real estate investing offers that powerful, appealing sense of tangibility and control over a physical asset you can see and touch. It provides the potential for magnified returns through the accessible use of significant leverage, a mortgage. And it comes with specific valuable tax advantages like the primary residence capital gains exclusion, deductions for investment properties, depreciation write-offs, and the potential for indefinite tax deferral via a 1031 exchange.
Those are some big pluses.
They are, but, and this is a significant but, these benefits come at the cost of massive upfront capital requirements, a potentially significant ongoing time commitment and need for expertise in management and operations, which can feel like running a business, and crucially, a profound sacrifice of liquidity. Your capital is tied up in an asset that is slow, complex, and expensive to sell quickly if circumstances demand it.
And stocks and REITs offer the other side of that coin, different trade-offs.
Exactly. Stocks, including REITs traded on exchanges, offer the opposite set of benefits and trade-offs in many ways. They provide high liquidity you can generally buy and sell quickly during market hours. They offer high accessibility with much lower capital requirements, allowing you to start investing with relatively small amounts and build positions over time.
Much easier entry point.
Much easier. You get instant diversification, especially through broad market index funds or sector ETFs like XLRE across many companies or properties, reducing single asset risk. There's a significantly lower management burden compared to direct property ownership. Someone else is responsible for the day-to-day operations of the underlying businesses or properties.
A little passive.
Generally, yes. And they have different tax treatments, like potentially lower long-term capital gains rates. However, as we discussed, they are more abstract as assets. You lack direct control over the underlying properties or companies, and they can be more volatile, although REITs are generally less volatile than broader market indices like the tech-heavy NASDAQ.
So it really sounds like neither investment is presented in the sources as a universal, always better winner. It's not one size fits all.
Absolutely not, and that's a key takeaway the sources strongly emphasize. The decision about which is better isn't simply based on historical average return percentages, although those are important long-term guideposts. It's fundamentally about aligning the characteristics of the investment with your own personal financial situation and goals.
So personal factors matter hugely.
Massively. Factors like your risk tolerance, can you stomach the faster, larger swings of the stock market or REITs? Your time availability, do you have hours a week to manage a property? Your access to capital, do you have millions for a direct commercial deal? Your desire for control, do you want to pick out the paint colors or just own a piece of the income stream? And your potential need for liquidity are just as crucial, if not more so, than historical return numbers in making the right decision for you.
So the sources suggest that for many investors, it's not necessarily an either decision. Maybe do both.
Precisely. The sources strongly suggest that for a significant number of investors, the most prudent and effective strategy isn't choosing one over the other, but adopting a diversified both-hand approach.
Okay, diversification again.
Building a balanced investment portfolio that includes exposure to both traditional stocks, perhaps through broad market index funds or growth stocks, and real estate assets. This real estate exposure could be through direct ownership if it fits your resources and goals, or more commonly, accessibly and liquidly through REITs, REIT ETFs like XLRE, or other indirect methods.
Right.
Diversification across these asset classes helps you potentially balance growth potential from stocks with the income generation and potential inflation hedging from real estate, spreading risk, and allowing your overall portfolio to be tailored to your specific long-term financial goals, risk tolerance, and liquidity needs.
And REITs seem like a good tool for that real estate piece for many people.
REITs in particular are presented as that accessible middle ground, offering real estate exposure with the structural benefits of publicly traded securities.
Okay, we've taken a truly deep dive today into comparing the paths of direct U.S. real estate investing and investing in the U.S. real estate sector via the stock market, using REITs and an ETF like XLRE as our focus example.
Yeah, we covered a lot.
We've explored the long-term data on historical performance, unpacked the fundamental differences in things like tangibility, volatility, costs, leverage, liquidity, and taxes. We've detailed the significant challenges inherent in direct property ownership, especially commercial, and highlighted how REITs offer a hybrid alternative with key advantages like liquidity, diversification, accessibility, and income potential, along with their own set of drawbacks. And we've grounded this analysis in the current U.S. housing market reality, dominated by high interest rates, the lock-in effect, and constrained supply.
The key takeaway distilled from the sources isn't about declaring a universal winner between direct property and listed real estate. It's about clearly recognizing and understanding the distinct characteristics, benefits, and significant challenges of each investment type.
Know what you're getting into.
Exactly. The tangibility, leverage, and tax specifics of direct ownership versus the liquidity, accessibility, diversification, and income potential of listed real estate like REITs. The most powerful strategy for you lies in aligning these traits with your individual financial goals, your available resources, capital and time, your personal risk tolerance, and your investment time horizon.
Match the investment to yourself.
That's the core message. As the research suggests, a well-diversified portfolio that thoughtfully includes exposure to both asset classes often proves to be a robust approach for long-term wealth building.
That makes a lot of sense. It's less about finding the best investment and more about finding the best mix for you. As we wrap up this deep dive, here's a thought to leave you with, pulling from the current market context we discussed. In a world where interest rates are a moving target and the real estate landscape is evolving dramatically.
Yeah, things are changing fast.
Think about the ongoing challenges facing traditional office and retail spaces versus the booming demand and pricing power in sectors like data centers, logistics warehouses, and infrastructure assets that REITs provide access to. How does your personal investment strategy need to adapt to thoughtfully capture these shifts and capitalize on the evolving dynamics within the real estate sector?
Good question.
And reflecting on our discussion of liquidity, do you truly understand the role that having accessible capital plays in your overall financial resilience? And are you factoring that need for liquidity into your investment decisions before you might find yourself desperately needing it?
Food for thought indeed. Understanding these dynamics and your own needs is key to navigating any market effectively.